resident guru on FRS 102.
Thank you.
Now, this webinar video format is quite new to SWOT UK, isn't that right, David?
Yes, it is. So we've been trialling it primarily this year in 2015, running it for our quarterly accounts and audit and tax update. So we ran 8 courses on the video format in 2015, and it seems to have gone very well. It's a little bit more pressurized for the lecturer, but hopefully it's a bit more engaging for people looking in, and you're seeing us now. Hopefully that's a bit more interesting than just a sort of disembodied voice and some PowerPoint slides. So it seemed to go well, and we have a studio here in Plymouth that we're sat in. We've just finished one in our London office, and so we'll be running over 60 webinars in this format in 2016. So hopefully people will get into that, and Adobe that we're using this platform, it seems to work very well with tablets and mobiles and things. So if you're interested in that and you haven't worked out how to do it, then let us know. You can access it on your iPad, your Android tablet, your iPhone, that kind of thing. So it should be very flexible for people and say a bit more entertaining perhaps.
Yeah, absolutely. Now, on our standard video webinars, you would be provided with full course notes, as you would do on all our webinars. This is a slightly unconventional course in that we've been asking you guys to give us your questions. So there will be no course notes on this particular course, but as David says, moving into next year, all our video webinars will have course notes provided on those. So now, as you probably already guessed, the title of this course kind of relays what we're going to be talking about. So we've asked for your questions on FRS 102, and over the next probably 30 minutes, we're going to be firing those at David and getting some answers to your questions. Some of you have very kindly already provided your questions to us, and we'll try and get through as many as we can in the next 30 minutes. Now, if you're looking for more training and support on the subject of FRS 102, don't forget that we do have a wide range of other training material on our website and free downloads. You can find out more about that at www.swot.co.uk/FRS102. So without further ado, let's get into your questions and let's get some answers to those.
Okay.
So question 1, FRS 102 states that a company does not have to revalue investment properties if to do so would entail undue cost or effort. Is there any definition of what constitutes undue cost or effort, David?
Yes, certainly we can talk about that. Actually, just before we do, Matt, I'm going to slightly interrupt. I can see lots of questions coming through on the chat. Unfortunately, we did say that we need the questions in advance. And so I can try and dip into them. We've got half an hour this morning if we get to that point. But we'll try and run one of these kind of sessions again, maybe to pick that up. And some of the questions that we're getting, they may take more than 2 minutes to talk about. So sure. Please be aware of that. This is primarily questions, as we said, that were emailed in advance. And so I'll try and get to some of the chat if I can, but please don't be upset if I don't. We're going to focus on what we've got in front of us. So yes, in answer to your first question, just reading the slide again then. So investment properties and any property, in fact, you don't need to revalue it unless you can get a reliable valuation without undue cost and effort. So what does that mean? It's not really defined in the standards. You won't see a definition of what undue is that I can see, at least not sort of numerically. It would come down to a decision of the directors. If we're looking at what practical guidance is out there at the moment, I think the expectation would be that your normal property, so if it's one that's an investment property at the moment and it's already being revalued, then you've already got a valuation that you're happy with. Because it's in the accounts and you've audited them, or it's given a true and fair view, and so it's hard to say that suddenly that is too difficult or too expensive to do because you've been doing it for the last few years. So I would have said something that's fairly normal property, certainly something that's been an investment property in the past, you can get that valuation without undue cost and effort. So I'm afraid just get on with it. And so certainly some of the commentary coming out of lots of consultants and websites are saying would expect that to work in the same way as it does now. The only advisor where I think my colleagues and I would say, oh, this is a situation that is unusual. So there is a change in the rules that group companies, if they rent a property from one group company to another, in the past, the SAP has excluded that from being an investment property. So you held it at cost. Going forward under FRS 102, it's taken away that exclusion. So let's say parent company rents a property to subsidiary, that under FRS 102 in the individual accounts would need to be revalued. The strange thing is then when you get to the group accounts, you take it all out again and put it back to cost. So to me, that seems totally pointless. You're going to have an individual company accounts that has this thing at evaluation, and on transition, we're going to have to revalue that 3 times. And then when we consolidate, we've got to take it out again. So I would think you could argue in that group context that actually this is pointless. It's pointless to have one company holding it at evaluation and the group doing something different. So the cost and delay, although it might be quite small, that is just undue because it's not giving users of accounts anything beneficial. So there's no official definition of what's undue cost, but I would think if you have that situation I've described, you could say clearly there's no benefit to the users of doing that, so I'm not going to bother.
Okay, that's great. Thanks for that explanation, David. Moving on to the next question then. This is another one that came in earlier this week. Will full FRS 102 apply to small companies who are currently ineligible for exemptions such as FCA regulated clients?
Okay, well that's an interesting question. There's not really, in one sense, enough detail in the question to answer that, but I suppose what I can say is that FRS 102 applies to all companies. Unless they're listed and they have to adopt full international accounting standards. So whether they're FCA regulated or not is irrelevant. FRS 102 is going to apply. Perhaps what the question meant was, are they talking about the small company exemptions under FRS 102? So for periods commencing 1st of January 16, FRS 102 applies to small companies. But an FCA regulated client, depending on what level of regulation they are, they're still going to be ineligible to be small. And so they can't be small. They will be on FRS 102 for periods commencing 1st of January 15, like every other medium and large company. So FRS 102 doesn't change who is ineligible. So if you're ineligible, if you can't be small, FRS 102 periods commencing 1st of January 15. If you can be small, it would be FRS 102 for small companies, periods commencing 1st of January 16.
Okay, that's great. So moving on to the next question we had submitted. It's a bit of a long one, so bear with us. Do fixed assets such as property need to be restated at current market values, or is it acceptable to bring them in at current depreciated values? Now, if a former, the cost of valuation may be prohibitive, especially for charitable organisations. So is it acceptable for this to be estimated by the trustees, or does it have to be carried out by a qualified surveyor or property valuer?
Okay, well, it's an interesting question, and I don't know the background, but the first bit is, do fixed assets need to be restated at current market values? No. So unless there's anything else going on, we haven't spoken to whoever wrote the question. I don't know what's in their mind. If it's an investment property, investment properties still need to be held at market value each year. But there is no reason I can think of, particularly why you would start doing wholesale revaluations of your fixed assets just because of FRS 102. You could opt to do a deemed cost revaluation. So on transition to FRS 102, you can choose, it's purely optional, you could choose to revalue your fixed assets and bring them in at a revaluation. That's not a policy of revaluation, so you don't have to revalue again, but you can bring them in at transition at this revalued amount. But that's a choice. I mean, you would only do that if you think, hey, what a great idea of improving my balance sheet. So you can absolutely leave your properties at depreciated historical cost if that's what you want. There is, I suppose, a slight wrinkle. If you have a look at the SORP there for charities, there does seem to be an indication that if you've got a mixed use property and you can separate the amount of the investment property from the functional asset, then that should be an investment property and that should be valued. If that's what the question relates to, and I have some clients looking at that, do we need to sort of split our head office, top floor is offices, bottom is rented out to someone for income, then that would be an investment property. But the valuation could be done by the trustees as long as it's reliable. So if they're using an appropriate model, if they're taking due care, then I don't see a problem with the trustees valuing that.
Okay, that's great.
Okay.
So moving on to the next question. Again, It's a slightly long one here, so bear with us. The use of fair value or revaluation as deemed cost on property, plant and equipment on transition, so relating to that in particular. Do we add back accumulated depreciation to the P&L reserve and increase this reserves? Use P&L reserve for the revaluation adjustment. Provide
Deferred
tax provision on excess over original cost only, or in relation to deferred tax provision, does this reduce distributable profits?
Okay, interesting question. So the first one, you've got a revaluation of a freehold property, and this is on transition. So we're not going to adopt a policy of revaluation. That doesn't actually change the accounting, to be fair, but this is a one-off revaluation at the transitional date. So if you think about making that adjustment, you're going to increase the value of the asset from its net book value to the revalued amount. So you are going to, yes, you're going to get rid of the accumulated depreciation, you're going to debit that, but you're then going to increase the value of the cost up to the revalued amount. So effectively all you're doing is increasing the asset by the difference between the revalued amount and the net book value. So that doesn't touch prior reserves at all. That doesn't touch the profit and loss account reserve at all. So you are going to clear out the old depreciation, increase the cost figure to the revalued amount, and then the difference between those two is going to go to a revaluation reserve. So this is not a fair value adjustment, it's an adjustment under the alternative accounting rules. And so just like you would do now, the net effect of that, so the credit is going to go to a revaluation reserve. So it's not going to affect distributable reserves at all. So I think that answers A. And B, do we use the profit and loss account reserve? No, that goes to a separate revaluation reserve because it's not a fair value adjustment. It is an alternative accounting rules adjustment. Question C then, provide deferred tax on the excess over the original cost? No. So you would look at what's the value in the account. So the new revalued amount, 5 million or whatever it is, deduct, yes, you do deduct cost and any indexation allowance. And so then you would calculate tax on the difference. But we're not, so we're looking at the whole value, but just like any tax calculation, you are deducting the original cost. And you can deduct indexation allowance, but you can't deduct other relief. So you can't say, I'm going to roll this over or do some clever tax planning.
Right.
So I hope that makes sense. Revalued amount, less cost, less indexation allowance. What's the tax on that bit? And then does the deferred tax provision reduce distributable profit? No. So you have to be a little careful under FRS 102. You could have a variety of deferred tax charges, one for normal timing differences, and that would go against normal profit and loss account reserves. But any deferred tax on non-financial assets, like this property here, that is going to go against non-distributable reserves.
Okay, well, thank you for that comprehensive answer, David. Move on to I think our last question we had submitted earlier this week. Can you talk us through the new structure for small companies? This particular question, they were confused as to what to prepare and what to file.
Okay, so this is the last question we had, which I admit is a slight fudge. I've made this up because I'm getting a lot of questions even this week talking to clients. So it's worth having a think about it in your firms. You perhaps have a little bit of time, and I'm desperate for a flip chart we would have had in the old days, but in principle, then, we're talking about periods commencing 1st of January 16. So we have a little bit of time to think about it. But for periods commencing January 16, small companies will come into FRS 102. So small companies in that period, then, they will adopt FRS 102, all the accounting under FRS 102, but with some disclosure exemptions. Wouldn't get too excited about those disclosure exemptions. They take you back to about the size of the frizzy. So, it'll still be fairly chunky accounts, just not as big as a medium or large company. So that's a small company. The question then is, well, what about abbreviated accounts? Abbreviated accounts are abolished for that period. So from 2016 onwards, there'll be no abbreviated accounts. So then we have a conversation with our clients potentially is if you want minimum disclosure and you can't do abbreviated accounts, what are your options? The options are proving very confusing, I think, to people. Let's say option one then is we prepare standard full accounts, no abbreviations because abbreviated accounts have gone. We do standard full accounts. When it comes to filing those full small company accounts, we can drop off the profit and loss account and director's report. So there's perhaps a few practical questions in that, especially if it's audited, a bit of extra disclosure in the notes and, how does your software cope and that kind of stuff. But in principle, if you're warning your clients what we're going to do, you could do option one, full accounts under section 1A of FRS 102. So full small company accounts, and just when you file it, you just don't file the profit and loss or director's report. So that's option one. Option two is you go for the abridged accounts regime. It is pointless, in my humble opinion. All you're doing in the abridged accounts regime is, primarily on the balance sheet, you are taking out only the disclosure that relates to the final level of detail in the balance sheet format. So, balance sheet, let's say debtors, you get to debtors, and then below that you have trade debtors, other debtors, and so on. Those amounts are never shown in the balance sheet because people would put that in the notes. All abridging does is says, well, you just don't need that level. So you get on the balance sheet, you get current assets, debtors, and you would just stop there. There's no need for the notes that would then give you more detail. But having said that, you've still got to have the other 13 notes that FRS 102 section 1A requires for small companies. So you're still doing related parties, you're still doing securities, you're still doing accounting policies, you're still doing lots and lots of stuff. So abridging does very little benefit for the client. Does it do anything to the profit and loss account? It supposedly drops off turnover and costs of sales, but the audit faculty have started saying, I don't think they give a true and fair view without turnover. So you're going to put turnover in, drop off costs of sales, and then have gross profit. So again, that seems a bit pointless. And to adopt these abridged accounts, you've got to have every shareholder's approval, which has to be done every year after the year end. So there's an admin task there in getting that approved. If you decide to do all that and you've prepared these abridged accounts, so you don't do full and abridged, you just do abridged if that's what you want to do, then when you file it, you can also take the profit and loss account and director's report off the abridged accounts. So in one sense, I don't care what's in the profit and loss account under abridging because I'm just not going to file it anyway. So it's not full and abridged, and then what do? You've got to have a decision. Is it full? So I've done my full accounts. So am I then going to file the lot or take off the P&L and balance sheet? Or maybe I decide to do abridged, some slight reduction in balance sheet detail, and then when I got my abridged accounts, I can throw away the profit and loss and balance sheet. Of course, the other thing, and I think perhaps this is the time where micro entities will raise their head. I don't know if you heard of micro entities. A lot of people have misconceptions. A lot of people have ignored them because they don't like them or they're new. But if your client says, well, wow, you're disclosing a lot more than you used to under the abbreviated accounts regime, then maybe now's the time to look at micros. And so today's perhaps not the time to go into detail on micros, but incredibly reduced disclosure. A little bit on directors' overdrawn loan accounts and guarantees. Otherwise, it's just P&L, an incredibly simplified balance sheet. And again, we're going to get rid of that profit and loss account because we don't have to file it. So micros, if you really want reduced disclosure, now we can't do abbreviated, micros are perhaps the way forward.
Okay.
So I'm just having a look at the chat, Matt, whether it's worth picking up those. And there's just one question. There is just one that's come in, and it says, should interest be charged on intercompany balances? I mean, perhaps, thank you for the question. That's a whole section. I don't know quite where to start on intercompany loans and balances. So I've got 5 minutes, give a little bit of background. We can talk about that. So under FRS 102, it says that long-term loans to related parties have to be held at their present value. So it's a version of amortized cost as the standard calls it. So we need to hold long-term loans, well, all long-term loans at amortized cost. So it's the present value. The problem of long-term loans from related parties is that often there's no interest charge. So the question then is, when you try and do this present value calculation for this long-term loan, do you use the actual interest rate, which is 0, and so there's no need to do any present valuing, or do you use the interest rate that you should have charged if it was a market rate loan? And actually you need to calculate the present value on what the interest rate should have been. So you have an interest-free loan from a parent company, say, to a subsidiary for 500,000. You need to say, what should the market rate be of that interest-free loan with no security and whatever repayment terms the parent company has offered. Once you get that figure, whatever that is, 10%, 20%, I don't know, ask a bank manager, look at Martin Lewis's website, I don't know, do something, work out that interest rate, which I know practically is very difficult. You then present value the loan based on that, what the interest rate should be. That's your initial recognition. So you're going to reduce the loan, debit the loan, credit capital contribution if the loan's from a parent. And then over the life of the loan, you would put in some notional interest based on that interest that you've estimated. So you would then bring in effectively annual interest charges based on the notional interest rate that you've calculated. So the question was, should interest be charged on intercompany loans? Well, in terms of interest actually being charged by the parent, that's up to you. I mean, it's up to the group whether they want to charge interest. If the parent charges a market rate of interest, there's no need to do this present valuing because because you've already got an interest rate that you're charging. So that's no problem. The problem why we're doing this complicated present valuing process and reducing the present value of the loans below cost is because there is no inherent interest in the thing itself, and so we have to bring in this estimated value. So it's up to you whether you charge interest to group companies, but if you don't and it's due in more than 1 year, then you need to do this present value calculation based on what the interest rate should have been. And it would be the same with other loans from related parties, long-term directors' loans. I mean, the other point the profession's talking about with these long-term loans is whether the terms really are supportable anyway. So you want to get something formal, something written. Ideally, it's drafted by a lawyer and not just you. And you want something that talks about when the loan is due, not just when the client intends to take it, which is very different. So it's not that the loan is going to be called in 5 years, 2 years, whatever it is. You want to have something that says, when is the loan due? If it's due in more than 1 year, then it can be a long-term loan. A couple of other questions, perhaps we'll deal with these and then stop. Does FRS 102 apply to micro entities? That's a good question. Sort of, I suppose, is the answer. Technically, micro entities exist now. Micro entities would currently be prepared largely with the FRSI, and then there's a couple of pages at the front of each FRSI. So the FRSI 08 has micro pages. The FRSI 2015, so this year's FRSI, that has micro guidance. When we move to 102, under 102, then we obviously couldn't look at the FRSI anymore, and so there was a choice, I guess, for the standard setters. Do we put micro requirements, just bolt them on the front of FRS 102? But then there's an awful lot in 102 that a micro entity doesn't care about, because micro entities don't fair value or revalue anything. So what they did was copied the relevant bits of FRS 102, stuck it in its own separate standard, added the requirements specific to micro entities, and that's FRS 105. So does FRS 102 apply? Well, a lot of the principles of FRS 102 will apply to micro entities, but you actually look at a separate standard, FRS 105, that pulls it all together. And basically a micro entity is FRS 102 without fair values or revaluations, basically. There's a few other tweaks, but that would be my starting point if you want a headline to sort of talk to clients about it. Another question, could you revisit director valuations or formal valuations for investment properties? Well, yeah, I said it before, happy to say it again. There's no need for formal valuations on investment properties. they can be done by the client. The standard says they have to be reliable, but presumably you'd say they're reliable now because they're included in the accounts, and you often audit them. So as long as the director makes a bit of an effort and has a proper model or does a bit of research and says, here's why I think the value is this, then that's absolutely fine. If a director says, I've no idea, you're the auditor, you value it, I have a problem with that. But as long as the director is making a sensible attempt at valuing it, then you could argue that's reliable, and then of course you will audit it or check it in the normal way. Okay, I think we're pretty much wrapping up. I haven't got any more questions coming through at the moment, so I'll hand back to you then, Matt.
That's great. Thanks very much, David.
Okay.
Well, I hope that's been useful. As David said earlier, we're hoping to sort of run a few more of these seminars through into next year. So this kind of format whereby you give us the questions and we'll do what we can to answer them. As I touched on earlier in this seminar, we do have some more information available on our website. So if you're looking for some more guidance on the subject of FRS 102, perhaps you don't know where to start, our free checklist is a really great place to start. That gives you a guide as to the things that you need to be thinking about now in terms of implementing FRS 102. You can download that for free from our website at swat.co.uk/FRS102. We've also just recently uploaded a free template letter for your clients, and that's available from the same page on the website. And for just a few more free video seminars generally, and for a whole listing of all our courses on the subject of FRS 102, you can find all that out and more at swat.co.uk/FRS102. Thanks very much for joining us today. I hope today's been useful. We hope to see you again soon on one of our future webinars.
Thank you.